Hi there, we're on topic 17, the accounts department. And so we're going to talk about what the accounts department does and some things that go on in the accounts department that you need to know about. We start to talk about different departments, and then we're going to learn how these departments actually work together at some point in one of the topics. But it's important to know what the accounts department does because it's key to a proper office running. And so let's get started. Of course, welcome to this virtual space. Let's work together to learn, share ideas, participate, and learn something new. The wise always seek knowledge. So when we talk about the accounts department, what does it actually do? What's the purpose of the accounts department? And so that means we're going to talk about its function. Key functions of the accounts department are going to be to record purchases made. So record every time the company pays a bill. To record any sales made. Anytime a company sells something or issues an invoice, we're recording that, which we should know to be revenue. Every time funds have been received from a customer, they're paying a balance on their bill, the accounts department makes sure it's recorded. Anytime checks are written or payments are made, the accounts department makes sure it's recorded. When it comes time to pay employees, the accounts department is involved in calculating that pay. And then there are instances where we're making small purchases like petty cash. The accounts department or someone in the accounts department is usually responsible for assisting with keeping track of any small cash payments made via what we call petty cash. So we're going to talk in detail about the role, its functions, payroll itself, petty cash, and paying bills in the accounts department. Equipment used by the accounts department are going to be things like calculators, copying machines, computers, adding machines, accounting machines, billing machines, faxes, anything that allows them to enter in the data, print checks, print invoices, send emails, calls, prepare invoices, send out statements. All these things are done in your accounts department. We have checks that are written by your accounts department. Definitely you want to be familiar again with when you're writing checks, know that the accounts department is the person that's going to prepare the check on behalf of the company and make sure that it's signed off on by only those persons authorized to sign checks. And so if the accounts department knows that we have the water bill to pay, the accounts department is going to make sure that a check is written up for whatever the name of the water company is to pay how much ever the bill is for by whatever date. And so the accounts department keeps a really good track on things like that so that they can prepare checks on behalf of the company to pay those bills. And so responsibility of an accounts clerk. Accounts clerk is responsible for doing things like paying salaries and wages on behalf of staff, writing checks. They're going to be responsible for preparing the checks and making sure that they're signed. They're going to be responsible for recording everything that's happening in the business in what we call the ledgers or the books of the accounts of the business. They're going to be responsible for invoicing, preparing invoices for customers, letting customers know what was purchased and what they owe. They're going to be responsible for reconciling accounts, making sure accounts are, and that's the books of the company, the records of the company, finances, and how the company is doing, making sure those accounts make sense. They're going to be responsible for writing up things in the cash book and the cash register, preparing financial accounts and trial balances that allow us to prepare our financial statements, our balance sheet and income statement, or balance sheet and profit and loss. When it comes to making payments, like I said earlier, they deal mostly with checks, but payments can be made either by cash with currency, denominations, and coins, by check, which is a written instruction to the bank to make a payment, by card, debit card or credit card, usually issued by the banks and allows persons to charge and pay back at a later date. That's a credit card. Some companies have credit cards that they allow their accounts department to make payments on, and then later on they write checks to pay off the balances on those cards at a later date. Or debit cards, depending on how big or small the company is. A company may have a debit card, and the difference between the credit card and the debit card is that with a debit card, you need to have the money on the account in order for the card to be approved and the payment to be approved. Versus a credit card, you don't need funds on the account. You just need to have a certain limit and not charge more than your limit. And so you just pay it back at a later date. Okay. Payments can also be made online as well too. Nowadays, persons have the capability of paying bills online, and so sometimes you can just put in a transfer from your bank account to another establishment, and that's a form of payment as well. But all of this is going to be done within the accounts department, whether it's initiated or started by your accounts clerks and a manager approves it, or a manager actually sends it. It all depends on the system or the setup or the way that the accounts department works, because it varies in each department. And so, like it says, payments are usually made once the department actually requests payment for an invoice. We make payments on things that we've actually received funds for, things that we've received a service for. So if somebody sends me an invoice and they ask me to pay it, in the accounts department, I'm responsible for making sure that this is something that I'm actually supposed to pay. It's not somebody just trying to get money out of the company without doing any work. And so that's why usually in accounts departments, because you're paying the bills of everybody else, there should be persons approving and requesting that payments are being made, because they've done, the person has done, or the vendor has done everything that they're supposed to do. And so I just wanted to point out key documents from the accounts department. We have an invoice, which is just going to be show your customer exactly what they purchased. So if they purchase products, it's going to list everything that's purchased. So think of a receipt. An invoice is kind of like a receipt, just that it's normally on bigger paper. And normally an invoice is created when the person is buying something on credit. A receipt comes after the payment is made, but sometimes persons buy on credit, meaning that you allow them to take the items out of the store without paying for it before they leave. But they take an invoice, which is telling them when you do, or I'm going to give you a certain amount of days to pay this balance off, and you have to pay it at a later date. And they just give you an invoice to let you know how much you actually have to pay within a later date. And so companies' invoices normally have the name of the company and their information, invoice details like invoice date, the date of the invoice, the due date, the period of time in which they want you to pay this bill. Each invoice usually has a unique number. The name of the customer normally is who it's being billed to. And then we have, these are going to be, a description of the items that are purchased. Unit price is normally the price for one of those items. Quantity is how much they're buying, and the amount represents the cost for this particular item at its unit price times the quantity gives you the full amount you're paying for all of these items in this line. And so that's kind of something to be familiar with. Unit price times quantity equals amount. And once you total it all up, you get a subtotal of everything that you're purchasing. Normally, if there's discounts or extra charges, they're below the subtotal. So in this case, they charge them about 10%. And so that means they calculated 10% of the subtotal, which is $465. So when they add it together and get a grand total, the amount owed from this invoice is $5,115 in total. So when payment comes in, you expect payment to be up to this amount for this invoice. Sometimes on the invoices as well too, a company may put their transfer information below that allows your customer to know when I'm paying it. If I don't want to pay it by check or cash, a card, I can just transfer it to your bank account, and this would be your bank account information. Terms and conditions just state the terms or what the company agrees to as it relates to the payment. We want you to pay the payment back within, in this instance, they're giving them 10 days because the invoice, they created it on January 1st. And so it's saying the payment is due by January 10th. So in 10 days, that's my condition. I will allow you to walk out of the store with my goods, but you have to pay me in 10 days. And so that's normally expressed on the invoice. And in most companies, they require the customer to sign at the bottom of the invoice, just as proof that to say, hey, yes, I did collect these items. Yes, I did get this service. And so this is just an instruction to pay the company for a service they provided or goods that they sold to them. You're going to see a word like debit memo. Just know that a debit memo does something very similar to invoice. It's just showing you, hey, in this instance, a debit memo say, oops, I might have forgotten something, or you got something else related to this invoice, and we're adding this amount that you now need to pay on top of this invoice. So sometimes maybe if there's a delivery charge that wasn't on the actual invoice, a company may send a debit memo and say, hey, we're charging you $20 for delivery on this particular invoice. And so it's just know that whenever you receive a debit memo, it's an additional amount to be paid. Here's an example of a credit memo. And so a credit memo does the opposite of a debit memo on an invoice. It says that, hey, something went wrong. Maybe you don't want the item anymore. And so as a result of that, you no longer have to pay a certain amount. And so whenever a company issues a credit memo, they have similar information, just like your regular invoice, the name of the company, the word credit memo. Each credit memo has a number, a date, who it's the customer information, all of that is on there. Items as well, your unit price, quantity, and amount. It looks slightly different, but as you can see, it's the same information. And so it's just telling me that if I look at a credit memo, it's telling me that this person brought back some cables, this person brought back 2 pedal arms, and they no longer needed the labor of 5 hours or 5 times 3, 15 hours, or 3 hours worth of labor that's charged at $5 per hour. And so therefore, I don't need to charge them $154.06 anymore. So I'm going to give them a credit memo, and they're going to apply that against the invoice. And so I expect them to pay the difference between the invoice and the credit memo, or use it as credit later on. That's a credit memo. So whenever there's a return, or there's damaged goods, or somebody doesn't want anything anymore, a company issues a credit memo acknowledging that this is an amount that they no longer have to, the customer no longer has to pay the company. We have a check register, which I talked about in the previous topic. And this is something that's prepared by your accounts department that keeps a register or a listing of the balance in the checking account. Because of course, if you're not keeping track of what's in your checking account, you're not going to know if you can write a check for $1,000, or you might not be aware that you only have $600 in your bank account if you're just writing checks and not keeping track of checks you're writing and deposits you're making. And so every accounts department, whether it's manually, you're writing it on a piece of paper, or writing it in your checkbook, or you're putting it in the system, has a register of everything that's happening to their bank account. And that's called your check register. And so what happens is the check register, you normally list all of the transactions that happen each month, or actually every day, and you're keeping a balance of what's in your company's bank account. So if I'm to follow this, let's say that this is the balance that came. They say this that this is the beginning. This is a May check register. At the end of April, this is saying that this is how much was in my bank account, or how much I did not use or have available to use at the beginning of May. And so on whatever date this is, it says that I have a number. This is normally a check number. I might have written check number 1033 for some groceries. and I wrote it in the amount of $123.78. If I have funds of $435.99, and I write a check, that means I'm spending, or I should subtract this amount from my balance. So now, once that person carries the check to the bank, I'm only going to have $312.21 left to use as payment. And so all of your checks are going to be tracked on this check register on one side. And then on the other side is going to be funds that I have available to use. In this instance, there was a deposit made to the bank account on whatever day. We normally don't have numbers for deposits. And so in the credit side, which is the plus side, I'm now saying that I deposited $10,000 on my account. What does that do to my balance? If I started off with $312.21 and I deposited $10,000, I now have $10,312.21 as a balance to use to pay bills. All right. From that point, I wrote another check. And this check I wrote for the dry cleaners, check number 1034, in the amount of $10.75. Again, checks are going to take away from the balance I have to use in my account. And so therefore, I'm going to reduce my balance by $10.75, leaving me with available funds of $10,301.46. And so in the accounts department, they're keeping track of every deposit, every bank charge, every check written, so that they're always aware how many funds do I have available to pay bills. And so that any checks written, I know that I can't write any check greater than $10,301.46, or else the bank is not going to honor it. And so that would be very irresponsible of me as an accounts individual. And so these check registers are kept by accounts departments on a regular basis. And actually at the end, what happens is the end of a month, what happens is your check register is actually reconciled against your bank statement. And so what does that mean? Reconciling a check register against your bank statement means that we're just making sure that we have everything that we need to have, and the balance that we're saying is how much we have available to use on the bank account is actually available. And so normally accounts departments would get a bank statement from their bank, which normally gives the details of the account for the particular month. And so you get a bank statement every month showing everything that happened on your account, every check that was brought in and reducing the balance of your account, every deposit that was actually made, every charge the bank charged you on your bank account is shown on your bank statement. So the bank statement is prepared by the bank and sent to the accounts department of a company, and the accounts department takes your check register and your bank statement and compares the information. All right. And so the balance shown on the bank statement and the balance shown in the check register are not always the same. You're going to have a balance at the end of the month on your bank statement, and you're going to have one at the end of the month on your check register. And so they're not going to always be the same, because sometimes if you write a check to someone, every time you write a check, you're putting that in your check register, but that doesn't mean the person took the check to the bank to cash it. And so timing differences are what affect the balances between your bank statement and your check register. And so the accounts department normally looks for these things that are off by timing. That could be checks not yet carried to the bank or cashed at the bank, and it could be deposits. Maybe you wrote up a deposit and dropped it in a night deposit box, but the bank hasn't opened it yet and posted it to your account. That is going to cause a difference in your account as well. And so these are things that you're going to look for in when you're reconciling a bank statement. Another thing can be that maybe the bank charge you a bank charge and you don't know what the bank charges you for fees until you actually look at your bank statement. So you won't have that in your check register, but it's an amount that you don't have access to anymore because the bank took it off of your account. And so normally when you find these differences, sometimes they require you to add them to your check register because you now know about them. And so those are some things as well that affect your bank reconciliation. We'll go into more detail on reconciling a bank statement in our Zoom in topic. So this is just a brief introduction to what happens, but just know that the accounts department has to reconcile a bank statement every month to make sure that they're aware of what's happening on the bank account, and just to make sure they capture all charges and they know what balance is available to make payments on the bank account. And so these are just the instructions as it relates to reconciling an account, a bank statement. What you want to do is you want to arrange any canceled checks, look at any checks that have been sent back from the bank. They normally send a listing of checks that or pictures of checks that they've actually received from persons that you gave checks to. So you're going to compare that to your system, make sure everything agrees. You're going to check the check register, and normally what happens is you tick on the side of everything that you see also on your bank statement. So you compare what's on your bank statement to what's on your cash book, and you tick off everything that you see. Things that you don't see are your reconciling items, and you use them to help you figure out, okay, is my statement correct, or is my checkbook balance correct? And so once you're able to reconcile it at the end of the day, then as an accounts department or accounts worker, you're satisfied that your records and your books are correct. Another big topic outside of paying for things by cash, check, are going to be petty cash. And so petty cash is just money that's kept or used to pay small expenses or buy small items in a company. Let's say somebody's going to buy gas for $30. Well, you may not want to write a check for $30 for gas. And so companies oftentimes keep a small amount of cash on hand. That way, if there are small bills to pay, a person can just come and request the $30, pay for the gas, and then bring back the receipt for $30, showing evidence that they actually paid, they used the funds for a legitimate reason. And so keywords to remember for petty cash are going to be things like float and impress. That's the initial amount paid in petty cash used for minor expenses. So we normally start off, let's say the company agrees, okay, you can have $350 on hand for petty cash. That's considered to be your float. That's the amount of petty cash that you should have at all times after you go back and replenish it or put money back into it. A petty cashier is a person in charge of the petty cash fund. So normally there's one person that's in charge of keeping those funds safe, issuing them to individuals, receiving the receipts, and actually reconciling it and replenishing it or reimbursing the actual box for that to get back up to that float. When we say reimburse, that means we're giving money back that was spent. When we say replenish, we're restoring or putting it back to its original state. So if the company agrees that you have petty cash of $350, and for the entire month, you spent $300 of that on different little small things needed throughout that month, what's going to happen is the petty cashier is going to put together a report showing what they spent the $300 on and requesting a check for the $300 spent, so that they can put the $300 back with the $50 that's left over and put the petty cash amount back to $350. And so that's what replenish means. If there is something that doesn't agree or something that's wrong, or there's a mistake or an error, then we call that a discrepancy. And normally it has to be investigated to make sure that there's no theft of petty cash. Petty cash receipts are just receipts or vouchers issued whenever money is taken from the petty cash fund. And then the impress system is an overall system that is used to track petty cash, or used to track the fixed amount of money reserved for expenses that we call petty cash. So how petty cash works, like I said, you have a petty cash amount that's approved and placed in a tin. Funds are spent on small purchases from different persons in the organization. They come and request it. And normally what happens is they fill out a voucher. So this is a voucher, a petty cash slip. You give it a number, you put the date you're requesting the funds, you describe what you want the funds for, how much you want, and the total amount that's being requested. Normally the person that receives, if I ask for $10, I'm going to sign as the person that received it. The person that's in the petty cashier is going to be the person that approves and says, it's okay, it's a valid reason to give them the $10. Therefore, I give it to them. Then once the person gets $10, they go and they buy what they need to buy. They bring back a receipt and it's stapled to the back of this petty cash form so that when it's time to replenish, you have to show evidence of what the funds were spent on. And so once all the funds are gone or the money is very low, the petty cashier requests a reimbursement. A petty cash form or report is completed, and then a check is written for the petty cash and cashed, and the cash goes back into the tin to be used again and again and again. And the process happens over and over and over. Sorry. And so this is just an example of a petty cash form, a petty cash book that can be prepared by a company. What happens is all of the receipts and payments that have been made are documented somewhere, which gives a description. If I purchased fuel, if I paid for water with receipt number 1 and receipt number 2 on these 2 days, you're going to track it in here, and you're going to keep a record of, your basic, what you're basically spending it on. And so if I say I spent $10 on water, I may have that considered to be a pantry expense. And so I would put it on any pantry that I spent $10 on water on this date with this particular receipt. If I spent money on gas, then I can put on this particular day with this particular receipt, I spent gas, and that was my fuel expense. And so the petty cashier keeps a detailed record and summary of what the petty cash was spent on, and normally gives this along with the receipts as proof of spending the petty cash and the replenishment amount needed. And the accounts department usually uses this to record, when they're writing the check, they record the expenses along with this check as well. Next is another big one, payroll. And so how payroll works is we have hours reported to the accounts department of how much time an individual has worked. And so the accounts department takes the amount of hours they've worked and calculates their pay based on the rate of pay that the employee agreed to in their contract. And so if they agreed to get paid $10 an hour and they worked 8 hours for the week, then they only get paid 8 times 10, a base pay of $80 for the week. Okay, and so the accounts department usually has this information and calculates how much payroll is. Now, payroll is just not going to be how much hours you worked and what you agreed to, but sometimes there are things like additions and deductions that affect the overall, what we call the net pay or the final pay of the employee. And so if you ever work a job, you're going to see that when you get a pay slip, which is just a summary of how your pay is calculated, you'll see that they have a regular base pay for you. Maybe sometimes they have something like overtime, which is an additional pay. You worked extra hours, so you get extra money. And then they have deductions like national insurance, are things that are taken out of your pay, whether voluntarily, meaning you ask them to take it out, or statutory is required by law. And then you're going to see how your pay is actually calculated. Once it's calculated, then the payroll department normally, or the accounts department normally creates a report that shows the total payroll for the pay period to pay to all staff. And pay slips are prepared and sent out to staff, letting them know how their pay is calculated. And the payroll happens and the funds are either transferred to the employee's bank accounts or a check is written. And so key terms when we talk about payroll are going to be your payroll register, which, like I said, is just your listing of everybody that's being paid, how much they're being paid, their base pay, any additions they got, any deductions they got. All of that is included in the payroll. We also have additional pay like commission. So commission just means that there are some employees that get additional pay based on sales. That's normally your salespeople. So the more they sell to customers, they get an additional pay or an additional amount that's normally calculated as a percentage of sales. So if you earn commission at 10% of sales, then if your sales is $1 million for the year, then that person gets commission of $100,000 extra added to their pay. So that's additional pay. We have gross pay, which just represents your pay after there were any additions added to it. So that's your base pay plus additional pay. We have net pay, which is going to be the amount that actually comes to your bank account as the employee. We have salary, which is just the way that a person is paid. We actually have salaries and wages. Salaries, there are some employees that sign up to get a certain amount every month or every week. That it doesn't matter how many hours they've worked. We don't really track the hours of the employee. They are normally considered to be salaried versus staff who are paid by wages. Well, their pay is based on the number of hours that they work. So if they worked 8 hours, then they get paid for 8 hours. If they work 4, they get paid for 4. Their pay changes based on the hours that they work versus salaried workers. Their pay doesn't really change. Of course, unless they don't come to work at all, then it may change, but their pay tends to stay the same every pay period. Deductions, like I said, are things that reduce the amount of money that they pay you at the end of the day. Might be for things, let's say you have a bank loan that you're paying off, you have a salary deduction. So that means that the company is not going to give you, if you have to pay the bank $300 every month, the company is going to take that $300 out of your pay and not send it to your bank account, but they're going to send it to the bank that you have to make the payment for. And so those are deductions, which can either be statutory, like I said, mandatory by law, which in our case is national insurance, or voluntary. Voluntary deductions tend to be things like your bank loan payments, because you're not required by law to pay those bank loans, only upon your request. We have things like taxes and duties that sometimes come out. In our case, national insurance is our tax. In the US, they have other taxes, Social Security tax, and all these other taxes that affect pay. We have an advice notice, which advice note just gives information related to how much is being paid. We have pay, PAYE, pay as you earn, which if you ever see that, that just means that persons are paid based on how much they earn ultimately. Time cards are just give you an idea of how many hours a person works. So it's used to determine the amount of hours worked in order to calculate the pay of the individual. So as you see here, this is an example of a pay slip that I found online. Normally it includes the name of the company, the period of time in which the employee is paid for, the employee numbers, the name of the employee, their position, and their rate or their pay. In this instance, this person looks like they're paid $512 a day, and they have an allowance per day of $50. And so allowance is considered to be additions to the pay. The regular pay or regular rate is just considered to be your basic pay. And so based on this pay slip, it says that Monday, Tuesday, Wednesday, Thursday, Friday, and Saturday, this person earned $512 for this week. When we add that together, his basic salary or his basic pay is $3,272. It says salary. So we're not concerned with how many hours he worked. We're just concerned with the fact that this is how much he earns per day. And so the allowance is $50 a week. And so 50, let's see, 50, 100, 150, 200, 250, 300. He worked 6 days this week. So 6 times 50 means he would get $300 extra in allowance. If there's any OT or overtime, it would be there. If there's any extra holiday pay, it would be there. There's also bonuses. Persons can get paid additional money. That persons that are agreed to be paid to staff is bonus, like Christmas bonus and things like that. It's added here. So he started off with basic pay of $3,000. This is his agreed upon salary. After his extra salaries, he now has gross pay or gross salary of $3,872. Wow, he's making a whole lot of money. All right. Down here, if he had any deductions, we would see amounts placed here. Let's assume that, let's say he had a deduction of national insurance of $100. Somewhere down here would say NIB or national insurance, $100. And then total deductions would say $100 because we would add up all of the deductions taken from him. And so once we have a deductions, his net pay would no longer be the same as his gross pay because his net pay would be $100 less, being $3,772 would be his net pay. All right. And so this oftentimes is created every time an employee is paid just to break down what the payment was made of. And it's usually prepared by the accounts department, somebody who specifically works with payroll, because not everybody in the accounts department would deal with payroll because it's kind of confidential. And then it's normally sent out, either printed or sent out by email to staff. Oops. Checks can also be used to make payments as well to staff in the same way we can pay anybody else, right? And so just to point out, when we're calculating pay, we first have to look at the final pay of staff being the net pay, like I said. And net pay is found by calculating the gross pay, which is your basic pay, plus any overtime, plus any bonus, plus any commission, like we just saw, less any deductions. Pay rates can be calculated as well, because sometimes when we have overtime can be paid as a single amount. Let's say we pay $50 once you work overtime, or we can say that you have a certain rate that you want to have to apply for each hour of overtime. And so sometimes they call it time and a half, or they may call it double rate. And so what that means is you just take your regular rate times 1.5 to figure out how much you get paid per hour for each overtime hour that the person worked. So let's say a person's regular rate is $4 an hour. Time and a half rate is going to be 4 times 1.5 or $6 per hour. So if they work 10 additional overtime hours, their overtime pay, if they're being paid at time and a half, is going to be 6 times 10 or $60. If they're paid at a double rate, that just means that the regular rate is going to be multiplied by 2. So 4 times 2 is $8 per hour. So if it's a double rate pay, that means if you work 10 hours overtime, you would have gotten additional overtime of $80, 8 times 10. Good position to be in. And so that's it for the accounts department. We talked about what the accounts department does, the equipment that they used, and then we also talked about key functions, which are paying bills. We talked about payroll, which is very important, and we talked about petty cash. You can replay these. I'm going to have definitely some zoom-ins from here that give a little bit more detail into the reconciliation and preparing checks and other things that you need to know for the BGCSE exam. This is a heavy one. Sometimes they can ask you to do check registers. They like to ask you to prepare invoices. They like to ask you to, sometimes they may ask to prepare a reconciliation. That's not that frequent, but they can. And they definitely like to ask you to write up checks, and you just have to know what is required when you're asked to write a check. And so go through this information, go through the questions, and feel free to send any questions or comments and let me know what you think, and happy studying. Hi, Brenda here. I just want to take the time to say thank you for choosing this course. Thank you for choosing yourself and for preparing as you should for Office Procedures BGCSE. Look forward to more from me and Business Teacher Powell, and I look forward to seeing you in other classes. Bye.